Good day, everyone. I'm Michael Chang, Chief Investment Officer, Fixed Income at RHB Asset Management. Thank you for listening to this update as we will be talking about rising bond yields, a keen topic among investors. We just had our webinar last week on 11th of March entitled Navigating Fixed Income in a Rising Yield Environment, hosted by RHB Asset Management. Discussions centered on the surge in yields were interesting and also timely. Now, to start with the economy, collectively there has been significant progress in the vaccine rollout. Back in January 2021, there were only 2 approved vaccines for full use. Now, in March 2021, we now have 6 approved for global use. Pfizer-BioNTech has been distributed to a few countries, including receiving our first batch in Malaysia, and in addition to taking delivery of Sinovac, another COVID-19 vaccine, in February. This momentum for vaccine approvals and rollout will continue in the next few months. For example, in China, CanSino and Sinovac has been approved compared to being tagged as limited use back in January 2021. The flip side of this positive rollout of the vaccine is it has also unleashed a sell-off in global bond markets, and Malaysia is not spared from this as well. ASEAN bond markets were rattled by sell-off seen in US Treasuries. It's worthy to note that the backup in yields are in sync with the US, unlike what we saw in March 2020 when it was dominated by risk of safe haven flows. From a technical valuation perspective, the surge in yields, that is the 10-year MGS, may signal a turning point as the relative strength index, the RSI, hit above 70 level. Currently at 89 level, it does indicate MGS 10-year is oversold. A pullback in yields should happen when the global bond turmoil settles. We are already seeing nascent signs of pullback in yields in the ringgit bond market over the past couple of days. Another way to infer value from this sell-off is, even from a historical spread perspective, that is the difference in yield between the 3-year and the 10-year MGS, the current MGS yield curve is one of the steepest, tracing back over a 10-year period. Spreads between US Treasury and 10-year MGS has also widened in tandem, and therefore there is definitely value in the MGS market right now. Clearly, we are seeing some divergence between portfolio flows in terms of the sell-off and policy rate expectations. BNM is expected to maintain the OPR at 1.75 unless a sudden deterioration in the growth trajectory prompts a cut. This is unlikely at this point of time in view of the relaxation measures under CMCO or MCO for most states in Malaysia. The rate of the vaccine rollout both domestically and externally could also raise hopes of a faster GDP rebound in second quarter, allowing BNM to look past first quarter of 2021's weakness due to MCO 2.0. In terms of domestic inflation, Malaysia's deflation narrowed to minus 0.2% year-on-year in January, a sharp improvement from minus 1.4% in December, a result of higher energy costs. The core gauge was stable at 0.7% year-on-year. In terms of outlook, further gains in oil prices suggest deflation may end in February 2021, and BNM did highlight a temporary spike in CPI, Consumer Price Index, in second quarter due to base effects. That said, Bank Negara expects underlying inflation to remain subdued this year due to ongoing spare capacity. To put Malaysia's CPI to a regional context, it looks relatively benign when compared to the rest of ASEAN economies. While expectations is for inflation in ASEAN to rise over the course of 2021, we expect monetary authorities in the region to hold on to their growth bias and keep monetary policies loose, as recovery in growth would likely remain uneven, especially to those countries that were severely hit by COVID-19 and trickled access to vaccines. Therefore, we believe BNM would maintain an accommodative policy rate, and rising inflation expectations arising from costs would not be a key factor in changing the direction of policy rate. After all, BNM has reiterated that there is an ongoing spare capacity in the economy. We share that view as well, and it is unlikely that the current inflation develops into a demand-led inflation in 2021. With policy rate being unchanged and bonds have become cheaper, we recommend to tactically increase bond exposures to buy on the cheap. From an offshore investor's perspective, Malaysia stands out in terms of capital market development, as income earned from MGS or GII are free from withholding taxes on par with Hong Kong and Singapore. We hope this podcast has been useful to you, and thank you for listening.